Imagine buying into a stock market, watching your chosen index shoot up 10% because the local companies are doing brilliantly.
Right, sounds great.
Yeah, but then you check your brokerage account only to realize you actually lost money.
It sounds completely impossible, mathematically speaking.
It does, but right now, in 2026, that is the exact nightmare facing foreign investors pouring money into Japan.
It really is a phenomenal paradox. You have this country undergoing historically positive internal economic reforms. But those internal wins are clashing violently with these severe structural external headwinds that just drain the value of its currency.
And that paradox is the exact mystery we are solving for you today on this deep dive.
Exactly.
We have a really fascinating stack of sources in front of us today. Deep macroeconomic analyses, strategic investment models, and some fresh policy roadmaps straight from the Bank of Japan.
Yeah, they've been busy.
Very. We are unpacking Japan's new era of what they are calling moderate inflation, moderate growth. But
Yeah.
our mission for you today is intensely practical.
Because the situation forces a very specific choice for anyone holding strong foreign currency right now.
Right. Like if you were sitting there holding US dollars or Australian dollars, you are incredibly well positioned. But what do you actually do with that advantage?
That's the big question.
Do you look at Japan's corporate overhaul and invest your capital in their financial markets? Or do you just book a first-class flight to Tokyo, stay in a five-star hotel, eat incredible Wagyu beef every night, and treat Japan as the world's greatest luxury consumption haven?
It is the ultimate dilemma, right? Financial asset investment versus lifestyle arbitrage.
Lifestyle arbitrage, I like that.
Thanks. Yeah. To answer it, we really need to completely pull apart the mechanics of what is happening on the ground in Japan today.
Which is a lot.
It is. Starting with the fact that they have finally woken up from a massive 3-decade economic freeze.
The infamous lost 30 years. I've seen that term everywhere in
Yeah.
these sources.
Yeah, it's unavoidable when talking about Japan.
Following the asset bubble bursting in the early 1990s, Japan essentially fell into this coma of deflation.
Right.
But I want to make sure we really understand the mechanics of that before we move on.
Sure.
Because deflation just means prices are falling, right? Which honestly sounds great for a consumer. Why is it actually an economic death sentence?
Well, think of it as a psychological trap that just freezes capital.
Okay.
If you know the refrigerator is going to be cheaper next month than it is today, you wait to buy it.
Why spend the money now?
Exactly. When millions of consumers wait, companies don't make money. And because they aren't making money, they don't give raises or hire new staff.
So it ripples outwards.
Yeah, workers then feel poor, so they spend even less.
Yeah.
This cycle just feeds on itself until the entire economy just stops moving entirely.
I picture it like trying to drive a car on a lake of sheer ice. The Bank of Japan, the BOJ, was in the driver's seat, absolutely revving the engine.
I'm totally floorboarding it.
They were printing money, cutting interest rates to zero, doing everything possible to get the car moving. But the tires had zero traction because consumers absolutely refused to spend.
The BOJ tried increasingly desperate maneuvers, honestly, to get that traction. They introduced negative interest rates.
Which is wild to think about.
Right. Essentially, charging banks to hoard cash, trying to force them to lend it out. And they implemented something called yield curve control.
Right. I see yield curve control thrown around in financial headlines all the time, but let's break that down for everyone. Mechanically, what were they actually doing?
So normally, a central bank only controls short-term interest rates. Yield curve control is when a central bank decides to pin long-term interest rates to the floor as well.
Okay.
The BOJ essentially announced they would print as much money as necessary to buy unlimited amounts of Japanese government bonds, just to ensure the 10-year interest rate stayed near zero.
Wow, unlimited.
Unlimited. It was a massive, unprecedented intervention to keep borrowing costs as cheap as humanly possible to stimulate growth.
So they're basically flooding the engine with fuel, and finally, the ice starts to melt.
It did, and we can pinpoint the exact moment the thaw became official. In March 2024, the BOJ finally ended their negative interest rate policy.
A huge milestone.
Massive. Over the next 2 years, they steadily normalized their monetary policy. By the end of 2025, they had raised the policy rate to 0.75%.
Which, that sounds tiny to someone used to U.S. rates sitting around 5%.
Right, it seems like nothing.
But for Japan, moving from negative rates to 0.75% is a seismic shift.
It signals a completely different economic regime. Now, here in 2026, Japan has officially transitioned out of that deflationary trap.
Which is amazing.
It is. Core consumer price index is hovering steadily near 2%. That is the holy grail for a central bank.
But the sources point out that the nature of this inflation is what really matters, right?
Oh, absolutely.
For a long time, Japan only experienced quote-unquote bad inflation, meaning things cost more simply because imported oil or food got more expensive. Economists call that cost-push inflation.
Nobody likes cost-push inflation. You want demand-pull inflation.
Demand pull.
Right. That happens when consumers actually have more money in their pockets and are actively bidding up the price of goods because they want to buy them.
And the data shows workers are finally getting paid. The 2026 spring wage negotiations, the Shinto, resulted in wage growth of around 3%.
Which is fantastic. And unemployment is historically low at 2.6%. The labor shortage is severe, which is forcing companies to pay more to attract talent.
And crucially, actual real wages, meaning wage growth minus inflation, finally turned positive in 2026. The Japanese consumer actually has more purchasing power domestically.
Yeah, so for a local worker in Tokyo, they are feeling a bit richer. The economy is growing, deflation is dead.
Okay, but this brings us to the massive pivot in our sources.
The paradox.
Right. If all of that internal news is so fantastic, why isn't the Japanese yen surging in value? Why does long-term currency depreciation still feel like this, like inevitable gravity pulling the yen down against the dollar or the Aussie dollar?
It's a great question. It's because a strong domestic consumer doesn't erase the massive structural anchors dragging on the broader Japanese economy. We really have to look at three interlocked forces here: demographics, debt, and energy.
Okay, let's start with demographics. Because I was looking at the demographic numbers in the macroeconomic analysis, and I am honestly struggling to comprehend them. Japan's population is actively shrinking by about 0.5% every single year.
It's staggering. The total population decline is concerning, sure, but the real anchor is the age distribution.
The aging population.
Exactly. The elderly dependency ratio is nearing 50%.
Meaning, for roughly every 2 working-age people, there is 1 retiree they need to support through taxes and healthcare.
Right, and that creates a massive structural constraint on overall economic growth. When your workforce is shrinking, your potential GDP growth is naturally capped.
Because there are literally fewer people.
Fewer hands making things mechanically limits the total economic output of the nation.
And those fewer working hands have to carry an unbelievable amount of debt. The source notes show Japan's public debt sits between 220% and 230% of their GDP.
Yeah, that is the highest in the developed world by a staggering margin. And this debt is the direct chain that links back to the weak yen.
Okay, connect those dots for me.
Remember those interest rate hikes we just discussed? The BOJ cautiously bringing rates up to 0.75%.
I do, and I'm guessing that massive debt load is exactly why they have to be so cautious.
You nailed it. Let's run the math on a national scale. When a government has debt equaling 230% of its entire economy, the interest payments on that debt take up a massive chunk of the national budget.
Right.
If the central bank raises interest rates by just 1 or 2 percentage points, the cost to service that debt explodes.
It would basically bankrupt the government just to pay the interest on its own bonds.
Exactly. The BOJ is completely trapped. They cannot aggressively raise interest rates to match the U.S. Federal Reserve or the Reserve Bank of Australia.
Even with the new Takaichi administration in 2026 pushing a, quote, responsible active fiscal policy, end quote.
Right, which means heavy strategic investments and stimulus to try and outgrow the debt. But the market sees the trap. The interest rate gap between Japan and the rest of the world isn't closing anytime soon.
Because if I am an institutional investor and I can get a guaranteed 4 or 5% return holding US dollars and less than 1% holding Japanese yen,
You're selling your yen.
I'm selling my yen and buying dollars immediately, and that capital flight naturally tanks the value of the yen.
That interest rate differential is a huge factor. But, a weak currency wouldn't be a complete death sentence if Japan made everything they needed at home.
But they don't.
The real crisis kicks in because they absolutely don't.
Which brings us to the third anchor, energy. Japan is an industrial powerhouse, but they have almost zero domestic energy resources.
None.
The sources put their energy self-sufficiency rate at just 15% to 16%.
Which means they have to import 85% of everything needed to keep the lights on and the factories running. And specifically, over 90% of their crude oil comes from the Middle East.
And the 2026 geopolitical context in our sources makes this terrifying. The ongoing conflict with Iran and the blockades in the Strait of Hormuz are causing crude oil prices to spike.
It's a perfect storm.
I want to trace the mechanism here, though. How does the price of oil actually sink the yen?
Okay, so oil is priced and traded globally in US dollars.
Right.
When a Japanese utility company needs to buy 1 million barrels of oil, they can't pay in yen. They have to go to the foreign exchange market, dump massive amounts of Japanese yen to buy US dollars, and then use those dollars to buy the oil.
So every time the price of oil goes up, Japan is forced to sell even more of its own currency just to survive.
The downward pressure on the currency is relentless, and it creates a brutal chain reaction internally.
How so?
Well, a 10% jump in crude oil prices pushes Japan's overall CPI up by zero point 0.3 percentage points. It introduces that bad cost-push inflation back into the system.
Undoing all their hard work.
Right. The government is then forced to drain its national reserves to subsidize retail gasoline just to keep businesses afloat.
So they have an aging workforce, a debt trap keeping interest rates at the floor, and an energy dependency forcing them to constantly sell their own currency. I mean, that is an incredibly gloomy picture.
It is the reality of their structural gravity, yeah.
But wait, I need to push back on this narrative of inevitable decline a bit.
Please do.
If Japanese companies are facing a severe labor shortage, which is tracked by the Tankan Index in our sources, they are being forced to adapt. But spending billions on robots to replace missing workers, I mean, isn't that just treading water?
How do you mean?
You are paying millions for a machine to do what a human used to do. How does that actually lead to new economic growth?
It's a fantastic question, and the answer is the productivity multiplier. But let's quickly define the Tankan Index for anyone not checking Japanese financial metrics daily.
Good idea.
It is a highly respected quarterly economic survey conducted by the BOJ. And right now, it is flashing bright red regarding labor shortages. Companies literally cannot find humans to hire.
So they are forced to automate out of pure desperation.
Essentially, yes. But automation isn't just a one-to-one replacement. A robotic arm doesn't just do a human's job. It works 24/7, it doesn't require health care, and it operates with zero error tolerance.
Oh, that makes sense.
Furthermore, Japan already has a world-class foundation in industrial robotics. They aren't just buying automation, they're inventing it.
Right.
By solving their own demographic crisis, Japanese firms are creating highly advanced AI and robotic systems that they will eventually export to the rest of an aging world.
So they're basically turning their biggest vulnerability into a globally exportable product.
Exactly. Well, think about it this way.
Mm-hmm.
Constraints breed innovation. This massive wave of corporate capital expenditure into AI and advanced manufacturing is modernizing their entire industrial base.
And that resilience connects to another major theme in the sources, right? The shift in global supply chains.
Oh, absolutely. The era of seamless globalization is fracturing.
Between U.S.-China trade tensions, tariffs, and just general geopolitical anxiety, global companies are desperate for a backup plan.
The popular term right now is the China Plus One strategy.
China plus one, right?
Companies want a reliable alternative to Chinese manufacturing. And Japanese companies are seizing its moment by aggressively executing nearshoring and reshoring of critical capacity back to Japan.
I see they're heavily targeting semiconductors and advanced materials. But wait, bringing a massive semiconductor fab back to Japan has to be vastly more expensive in the short term than running it in a cheaper emerging market.
The short-term labor and construction costs are higher, yes. But a semiconductor fab isn't just a single factory, it's an entire ecosystem.
Like a hub.
Exactly. When you build a fab in Kumamoto, you spawn dozens of high-tech supplier companies all around it. It drives massive domestic investment, creates high-value engineering jobs, and fundamentally boosts Japan's supply chain security.
They're building an economy less vulnerable to global shocks. So the internal transformation is incredibly real. They are automating, reshoring, and raising wages. But we have to bring this back to the core mission for you, the listener.
Right. The dilemma.
If you are sitting in Sydney or New York, checking the exchange rate, that internal growth is completely invisible to you. If you have US dollars, does it make sense to invest in Japan's financial markets to capture that corporate growth? Or should you just fly there and spend your money?
Let's evaluate the mechanical risks of investing first. You have to compare the potential gains from Japanese equities against the persistent risk of currency depreciation.
Let's use the 2025 numbers from the sources. The USD to JPY exchange rate approached 160. That is historically weak for the yen.
Very weak. So assume you are a U.S. investor. You see Japanese companies becoming hyper-efficient with AI. You buy a broad Japanese stock index using your US dollars, which obviously get converted to yen.
Right.
Over the next year, those companies perform beautifully and your stocks go up 10% in yen terms.
So I'm feeling like a financial genius.
But over that same year, because of the debt trap and the energy dependency we discussed, the yen depreciates by 15% against the dollar.
Oh, no.
Yeah. When you go to sell your stocks and convert your money back to USD, the currency drop has completely wiped out your stock market gains. You actually lost money.
Structural gravity of the currency just destroys the asset premium.
Exactly.
But wait, institutional investors don't just leave that to chance, right? They use foreign exchange hedging. Can't an investor just buy a contract to protect themselves against the yen dropping?
You can hedge, sure, but we need to look at how a currency hedge is actually priced.
Okay, how does that work?
Mechanically, to hedge against the yen dropping relative to the dollar, you essentially have to borrow in the higher yielding currency, the dollar, to buy the lower yielding currency.
Okay.
The financial market doesn't let you do that for free. The penalty you pay is roughly equivalent to the difference in interest rates between the two countries.
Ah. So because U.S. rates are around 5% and Japanese rates are under 1%, that massive 4-something% gap is literally the fee you pay for the insurance.
You got it. The hedging costs just eat the profit before you even start. For the average foreign investor, navigating Japanese financial markets right now is incredibly frustrating because the currency dynamics fight you every step of the way.
Which brings us to the much more fun alternative.
Always the better option.
The sources describe Japan right now as a, quote, global consumption depression, unquote, meaning a place where foreign purchasing power is absurdly high.
Yeah, we're talking about purchasing power parity, or PPP. It's an economic theory that compares different countries' currencies through a basket of goods approach.
Like the famous Big Mac Index. How much does a burger cost in Tokyo versus New York?
Essentially, yes. And right now, the purchasing power parity is heavily skewed.
Because of the weak yen.
Right, because the yen is so fundamentally undervalued compared to the strength of the dollar, the Aussie dollar, the actual goods and services inside Japan are vastly cheaper for a foreigner than the exchange rate would suggest they should be.
It's basically an economic arbitrage of lifestyle. Like a high-end Michelin star omakase sushi dinner in Tokyo, once converted to dollars, feels like a rounding error compared to a similar meal in New York or London.
It really does.
You get world-class infrastructure, impeccable service, and top-tier goods at a massive discount, simply because you are holding the right currency.
So for a foreign consumer holding strong currency, treating Japan as a luxury tourism destination might actually yield a higher lifestyle return on investment than trying to extract yield from their volatile financial markets.
But surely the Japanese government knows this is happening. The tourism boom is obvious. Can the structural reforms they are executing eventually save the foreign investor?
That's the hope.
Will the ship ever turn enough to make financial assets worth the currency risk?
That is the long-term objective. If Japan successfully executes its labor mobility reforms, meaning getting more women into leadership, keeping older citizens engaged in the workforce, and making it easier for people to change jobs to higher productivity sectors, that organically boosts GDP.
And if their massive investments in green energy and nuclear restarts work out, they slowly reduce that 90% dependency on Middle Eastern oil.
Right, which stops the bleeding on the yen.
That makes sense.
Combine those two factors with the successful integration of AI and robotics, creating an exportable advantage, and Japan could genuinely accelerate its per capita growth. The yen would stabilize, corporate profits would soar, and the unhedged foreign investor would finally win.
But until that structural transformation takes deep root, the gravity of debt and energy remains in control.
Exactly. For now, the cost of hedging, or the risk of unhedged depreciation, makes the investment landscape incredibly treacherous for foreign capital.
So, to summarize the massive journey we've been on for you, Japan has definitively broken out of its 30-year deflationary ice age. The Bank of Japan is normalizing rates, real wages are finally growing, and the domestic consumer is alive again.
But they are fighting immense structural headwinds.
Right.
A rapidly aging population naturally limits growth. The highest debt load in the developed world traps their interest rates at the floor, and a crippling reliance on imported energy forces, constant currency devaluation during global geopolitical stress.
Which keeps the yen weak. But rather than accepting defeat, Japan is heavily betting on a highly automated future, reshoring critical supply chains, and replacing missing workers with advanced AI.
They are attempting a profound transition from a stagnant economy to a sustainable, highly automated, low-growth model.
Which leaves us with a final thought I want you, the listener, to really mull over.
Oh, this is a good one.
Right now, we look at Japan's shrinking workforce and their aging population as a unique Japanese vulnerability. It's the reason their currency struggles, it's the reason their debt is so dangerous. It is viewed by economists everywhere as a cautionary tale.
A totally unique demographic crisis.
But look at the birth rates plummeting across the rest of the developed world today. Look at Europe, look at South Korea, look at the United States.
The demographic cliff is coming for everyone.
Is Japan actually just 20 years ahead of the rest of us? If their massive gamble on AI, robotics, and supply chain resilience actually creates a sustainable model for a shrinking population?
Then what happens?
Will today's cheap Japan, the place we just fly to for a luxury vacation, become the exact economic blueprint the rest of the world desperately tries to copy tomorrow? Something to think about the next time you check the exchange rate.